Hey everybody. For today, I'm going to take you through this brief introduction to modern monetary theory. It's not going to be completely a coverage of everything that would be involved in a discussion of modern monetary theory or MMT, but it is going to be an introduction to the kind of fundamental concepts, including the basics of how markets work and why the way the money flows in a market when it originates kind of gives us a lot of insight into what is likely true and what seems to be true from MMT as far as what we can pull from empirical data sources. So let's just dive right in. All right. So first, just getting into some of the background vocabulary in case any of this is fresh for you. Money is anything that acts as a unit of account, a medium of exchange, and a store of value. Full employment is when all people searching for and able to work are employed. Typically, when potential real GDP is the same as real GDP, is a good indication of when an economy has reached full employment. Monetary policies aimed at influencing the economy through the money supply and interest rates. Fiscal policies aimed at influencing the economy through government spending and taxation. Consolidated government, the central bank, the Fed, in the case of the U.S., and the U.S. Treasury acting in chorus. So acting together is usually, consolidated government is usually how MMT theorists describe the actions of government, and we'll see why they would consider the Fed and the U.S. Treasury as a consolidated entity. Crowding out is when increasing the costs of the private sector investment by public sector use of shared, scarce, loanable funds. So when the public sector borrows, there is a theory that crowding out may occur if the public sector's borrowing reduces scarce, loanable funds and therefore increases the cost of those loanable funds, which would be higher interest rates for the private sector. There's also the concept of crowding in, though. When use by the public sector of scarce loanable funds encourages private sector investment. So when the public sector's spending actually seems to encourage more investment from the private sector than would have existed had the public sector not actually spent. And inflation is the general rise in the price level of an economy, resulting in a drop in purchasing power. So let's start off with an origin story to help us better understand the role of money, and that will be essential in our understanding of MMT concepts. So markets kind of come about out of a need to have people with scarce resources find others who also have scarce resources and therefore need to or may possibly be able to trade the scarce resources they have for the ones that the other person has, so that both can have a little bit of all the scarce resources. This is on its basics bartering, right? So people need to barter effectively is where we come up with the origin of a market. People have things, other people have other things. We want a bit of what they have. Boom. Unfortunately, though, markets can have inefficiencies, and sometimes that inefficiency can take the form of a security threat like Swiper. So now Swiper is stealing things in our barter market and making it inefficient so that the barterers are not only dealing with each other, but also dealing with the cost of an intruder who wants to cause chaos and theft. So the market participants decide to deal with this, and they need to do so, of course, by scaling together their resources and pooling them together so that someone who's independent, fair, can actually enforce security and prevent people like Swiper from being active. But how would they go about doing that? Well, they'd go about it probably by forming government. So now we have this origin of where a government comes about, and it comes about because of a need to deal with a market inefficiency, right? So the birth of a government. How do we actually go about creating this independent, fair branch that will serve our market participants? well, they'd first have to come together and write the other, maybe less economical parts of the government. They'd have to write this constitution, enshrine their rights. Hopefully, this right also gives them rights to property so that they can actually barter with some security that they have a right to the thing that they are bartering with. But how can government, even if the Constitution is written and everybody agrees and there's this beautiful document, how does government even enforce this thing? How does it ensure that it can actually protect these rights? How will it even get the resources to do these things? Because it's not actually a corporation, right? It's not a business. It's not capitalized in the sense that a business is capitalized. So government needs to actually persuade and acquire, or at least it needs to actually persuade other parts of the market to do what its bidding is, so that it may actually enforce this constitution and have an actual like influence and purpose. Because without that ability to persuade, government is just empty. It does not have wealth, it does not have capital, it is just an empty vessel. So it will have to rely on making promises to people to get access to their goods and services. These promises, though, will only have the faith in the government backing them, because government has very little else to offer at this stage. So those promises sound a lot like currency, actually. These pieces of paper that are effectively IOUs issued by the government that only have the backing of the government, of the faith in the government to give them value. But they do actually play a critical role in the government being able to persuade people to actually give government access to their goods and services, including their labor. So, how does this paper even kind of like work? Well, we have to now consider the residents and the taxpayers in our basic economy. So, Dora happens to be participating in our economy. Lucky us. And in this case, government can try to hire Dora to work the role of security by using these IOUs, these promises, these pieces of paper that promise Dora and anybody else who holds these pieces of paper that they will have access to resources in the future. Government is basically issuing these pieces of paper saying, if you have this, it will secure you access to resources equivalent to the value of whatever you've agreed upon to even receive it in the first place. So if Dora agrees that 50 pieces, 51 dollar denominations, or 1 unit denominations, I should say, of this currency is enough to compensate her for a week of her labor, then that will guarantee her, those 50 units would guarantee her access to resources equivalent to what she would have been satisfied with, theoretically, as payment for her labor in the future. It's just that because government does not have anything, it cannot actually give her those resources. But government can make these promises and give her these pieces of paper to promise her resources in the future. So Dora goes with it. She becomes Officer Dora. And now we have to kind of consider, how do we get Officer Dora's buy-in, kind of, and others to buy in to help pay for the services in the future, even if the government is fronting the costs of it now, right? Because the government is basically playing this third party to these barterers, and the barterers are basically coming together and saying, we need to create a third party to protect us. This third party needs to be independent of either of us, and this third party needs to be able to ensure that we are all playing by the same game and that we're all safe. They created this third party, but now they need to kind of, like, the third party can front these resources, right? Like, if everybody who's participating believes in the third party, in this government, then the government can front these resources. But at some point, right, there's going to be there needs to be a buy-in, so the government has the ability to actually make good on this promise in the future. There needs to be something that distinguishes the people who may benefit from these services the government provides. What's the cost? I mean, what would be the buy-in, right? The government's already issued the currency as their IOU. What is the buy-in for them? So the most obvious buy-in would be tax enforcement, that the government would have to actually collect taxes from people who would then be able to acquire the resources of those like Dora and others hired by the government with these pieces of currency. So why are taxes so important then? How do taxes kind of make this all work? Well, the government can use taxes for a lot of corrective purposes, but we can also use it to enforce that this piece of paper that we've issued that is otherwise useless beyond people's faith that as a government we will make good on the promise. We can actually now enforce that currency that we've created is a medium of exchange. What we're basically doing is making sure that anybody who benefits from the government has to pay the government something as a buy-in, as an indication that they are a participant in this kind of like third-party system that we have going on. This third party's protection. That they are a participant in the market and able to get this protection. The only way they're going to do that, or the best way to do that, is to have them actually pay the government back in those same pieces of paper, because now everybody operating in the economy has a reason to try to collect those pieces of paper. All the borrowers now need to try to collect this piece of paper if they want protection from Officer, or in this case, it looks like Sergeant Dora. I guess Dora is getting promotions left and right. Sergeant Dora, as she is trying to deal with the threat of Swiper. If you want to be able to be helped by Officer Dora as well, you will need to pay taxes so that you are a citizen, a tax-paying citizen in our economy, and therefore qualified for these government services. So what ends up happening? The government ends up paying Dora. Dora fights off Swiper. Market participants can go about their thing, but now they want to use our currency as a medium of exchange because they all need to pay taxes so that they can keep their protection away from Swiper through Officer Dora. But the only way they can pay the taxes, the only way the government will accept the taxes is in the same IOUs that they paid Dora in. So what you basically have are a bunch of people who are now very eager to provide Dora with goods and services so that they can get a little bit of the pieces of paper that she's getting paid in. And the same thing will apply to everybody else who's dealing with the government and accepting payment from the government in exchange for their good or service. They will all also be theoretically catered to by anybody else in the market who wants protection from Swiper, but needs to collect those pieces of paper in order to pay taxes to get protection from Swiper. So now that we have this full origin story fleshed out, let's talk a little bit about what it actually concretely illustrates. First, it illustrates that fiat currency serves as a government's promise to its holders of access to resources in the future. So it's kind of akin to a code check token, right? Government gives you this token in exchange for your code, which in this case would be your labor or maybe a good that you make. And they say, hey, take this token and this token will be useful to you in the future to get resources. And because you have faith in the government, you accept the token, right? Also, point two, government in its origin doesn't need to actually borrow or tax in order to spend. What we saw in this example is that government was able to spend before any concept of taxation or borrowing. And if you actually think about it, taxation and borrowing doesn't make sense at the origin point for the government because there is no currency for it to borrow in or to tax. And what you'll realize as we go through this is that for sovereignty, for a government, an important concept of sovereignty is that a government only has debt issued in its own currency. So to get to even that point, the government actually needs to spend first. And therefore, it actually makes the most sense. The government would not tax or borrow before it actually ever spends and issues those IOUs that it will then ask people to pay it back in the form of taxes, or will ask people to loan back to it in the form of debt if necessary. So I just went over that point. Government spending is the origin of money creation, is the next point, that the IOUs coming do not come from just from a central bank, but actually are coming from government spending and creating a need to issue IOUs. And taxes enforce, or I should say, taxes reinforce a government's monopoly over money, which it already has a monopoly because it is the only person who can create the IOUs. But that monopoly also gets then reinforced by taxes, which create a reason for accepting the issued currency. So now people accept the IOUs that are printed because they have to pay taxes to get access to the services provided by government, would be the major origin theory of why government has a monopoly over money, and why and how taxes work to ensure that that currency actually has meaning, why people actually accept the dollar, for example, as a currency. And then finally, taxes to some extent are actually economic incentives. They incentivize economic activity because they manufacture a reason for it. If there are no taxes, then there is no reason to actually participate in economic activity in the jurisdiction to pay those taxes, right? Like, otherwise you are just participating for the sake of fulfilling your own needs as far as like this bartering goes. But if you can acquire those things from somewhere else, from another jurisdiction, where you are insured protection, for example, with lower taxes, or you're insured protection without taxes, I mean, there's no reason to actually do the business in your environment, in your jurisdiction. All I need to do is fulfill my needs. I can find the lowest cost place to do that. The ability to offer protection, the ability to offer government services is an attraction, theoretically, for people to do economic activity in your jurisdiction. On top of that, your ability to collect, your requirement that you collect taxes in the currency that you are using to provide those services ensures that people will actually participate there in your jurisdiction because they have to pay back taxes to you in your currency. And to do so, they need to participate in your actual economy. We'll get into more of the depth of this, of all these points in a bit. So first, the fiat currency is a promissory note from the government, right? This may be more familiar to most folks. At its origin, fiat currency is basically an IOU because it's the thing backing it is the faith of people in the government. And the government basically saying, whoever holds this has access to resources in the future. The government makes good on this promise, though, through taxation. If tax liability can only be paid with the issued fiat currency, then that imbues the currency with value. Because if you want to be under the protection of the United States, then you will do economic activity within the United States that collects you dollars so that you can pay dollars back to the government in assurance for the fact that the government will make sure that your streets are paved, that crimes are investigated and prosecuted. So, another little example here, Dora's glad that she got all those papers from the government for being a cop because everyone now is trying to cater to her and actually sell her things because they also need to pay taxes if they want protection from the police, if they want to be able to use the roads to deliver their actual goods and services to their customers, then they will all want to collect currency so they can pay taxes. Next point, sovereign governments don't need to finance their spending. How is that possible? So how is it possible that a government doesn't need to tax or borrow before it can spend? If your government prints and spends in its own currency and has no debt denominated in foreign currency, why would it? Remember, a government doesn't actually have wealth to protect. It's not a household. Its only mandate is to provide some goods and services, right? It's providing necessary services, I should say, to fulfill its constitutional mandates. And that really, again, only requires compelling the private sector to transfer to the government real resources. And that can be done perpetually without ever actually balancing out what you are offering to the private sector with some sort of real wealth, because all you're trying to do is compel the private sector to provide things that fulfill your mandate. You are not trying to actually collect wealth yourself. So as long as you can continuously compel the private sector to do this, it doesn't matter whether or not you are financing what you are doing, quote, with quotes around financing. So as if you need to buy more high school teaching labor, as long as that teaching labor is offered in your currency. So as long as somebody is willing to teach a class and accepts payment of your currency in exchange for teaching that class, which they likely will because they want protection from the government and they want services from the government, then yes, government can theoretically just continue to print and spend. Of course, empirically within some bounds, but theoretically, with all of these quotes attached to it, theoretically, if the government is only spending in its own currency and only printing its own, and it prints and spends in its own currency, it has no debt, it owes nothing to anybody denominated in another currency, then yes, it can basically continue to do this to a large extent. We can see evidence of this in that there is a moderately negative correlation between changes in the size of the U.S. federal debt relative to the economy and changes in the 10-year Treasury rate, which would be a proxy for the cost of issuing more debt. Basically, that higher levels of debt, increases in the federal debt, seem to come along with decreases in the 10-year Treasury rate and the cost of that debt. So to some extent, it doesn't seem like if the relationship that we were expecting was that there was some actual balance of wealth that needed to be protected and there was some balance of wealth that investors were concerned about, you would likely see that the cost of loaning to the federal government would increase as the federal government took on more debt and owed more to other people. But you don't see that because there doesn't seem to be a material concern that there will be a problem paying this debt in the future, because there might be an economic understanding that as long as the government can print and as long as the government only owes in the paper that it is printing, it is the final determiner. It determines whether or not it will default, and therefore it can never default because the government will never choose to actually default. Moving on, printing more money. Inflation. Well, not so fast, not really, right? Inflation is driven by the size of the money supply. Isn't a problem for a sovereign government that is using its own currency, because that government can tax, and taxation basically acts as a release valve for the amount of currency floating in the economy, and therefore allows the government to at least have control over the determinants of inflation that are derived from money supply. Government spending can also be adjusted in consideration of how much private spending is already occurring, so that we can really think of surpluses and spend in the budget, right? So the idea of the surplus or deficit spending, spending in excess of financing or spending below financing. So if you have a surplus, you are spending under the amount that you are collecting in taxation. If you have a deficit, you are spending over that amount. These are neither good or bad, because government spending should really be adjusted in consideration of private spending, so that inflation from just demand side activities, from demand pull inflation, is also kind of tamping down. So between those two approaches, government can have a really good control over the amount of inflation that exists in the economy, even if printing money is kind of the mindset of how you deal with the need to spend, right? So you spend and you tax away, and in that process of taxing away, you are pulling cash out and reducing the pressure for inflation. We can see that inflation, especially since the late 80s, has detached itself almost entirely from changes in the monetary base, so that you see that the monetary base, especially after the Great Recession, the Great Financial Crisis of 2008, 2009, spikes in that had little to no impact on inflation, and the rate of inflation does not seem to be really changing dramatically compared to changes in the size of the monetary base. So we don't really see a connection between the amount of money that is flowing in the economy and inflation in a way where there seems to be some support that other things are large determinants of inflation. There could be a whole other presentation on those, including the aging of the economy, or aging of the participants in the economy, I should say, and the fact that the economy is much more globalized, and therefore prices are better informed by the global markets as well as by better price information through avenues like Amazon, where just the internet and large markets on the internet allow for people to compare prices very quickly. A lot of these things the short stories, a lot of these things have more of an impact on inflation than even the monetary base within the US. And you can see that coming into the data, and it's kind of, if inflation is a concern, you can probably set that aside at this point if that is your concern with the idea of printing money for government spending, or government spending that isn't financed by taxation or or even debt. And you'll see that in a second. So I guess this is where I would be caught, right? Because if government spending doesn't need financing, then why do we even need taxes? And again, kind of harken to this before, taxes can have a lot of purposes. They are tools of social justice. I want to be clear about that. They are corrective of market inefficiencies, and they are a first-line fiscal treatment for things like inequality and poverty. From the previous slide, we can gather they also probably help with controlling inflation, but none of this means that the level of taxation actually needs to match the level of government spending. And this typically comes from a misleading way of thinking of the fiscal options in terms of a budget, which isn't really accurate. Budgets require balancing to prevent dissaving, and government has no wealth to really protect. So it's not really in the business of trying to save or dissave. Government is really in the business of trying to fulfill its constitution and ensure that it maintains a stable economy while it does this. So economies like the US typically run current account deficits, which means that on their current accounts, which are usually more consumerish items that are purchased from overseas, the current account is usually in a deficit, indicating that the US government purchases more of these kind of more consumables from overseas than they end up selling overseas. This is the U.S. government usually has to run, or I should say, the U.S. economy usually runs a deficit in this way when it reaches full employment. So when we reach what we think is an indication that everybody who is looking for a job has a job, that the resources of the economy, the capital resources, are fully being utilized, we typically see the U.S. economy in general is purchasing more consumer goods from overseas than they are actually selling. And at the same time, the U.S. government is typically running a fiscal deficit, which means the U.S. government is also typically spending more than it is taxing. All these things are typically the case when there is a full employment economy, and kind of indicates what's that a full employment economy may be achieved, or best achieved, when all these things are true, including when the public sector is running at a deficit. So if government spending doesn't need financing, why do we even borrow? Theoretically, we don't even really need to issue debt, but it can be a fiscal policy tool in its own right, since it provides interest payments to the rest of the economy. Debt instruments also give central banks a way to maintain price stability, which we'll talk a little bit more about the central bank's role in all of this. But if the fiscal policy side issues debt, then the central bank can drain or add reserves from the banks by buying or selling government debt to the banks. and influencing the rate then the banks charge each other to borrow reserves. And safe public debt instruments serve as an important role in the financial world. And even though government issues debt, if all the debt is denominated in its own currency, it's effectively always going to be safe. There will always be enough tax revenue in the future to meet debt obligations, quote unquote, as long as capital isn't exponentially fleeing, which means as long as the capital isn't leaving the economy, and definitely not leaving the economy or shrinking at a rate faster than the interest payments, then you should expect the economy to meet these needs in the future. It should be able to meet its debt payment. The more common look at this, or the more common way to evaluate this, would be like, is the economy expanding faster than the interest rate on these debt obligations? If the debt obligations have an average interest rate of like 1.3%, and the economy is expanding at over 2% a year, then it's not really an issue, because that expansion means that there will always be enough tax revenue in the future. The government will always be able to raise taxes enough in the future to meet any obligations on its interest payments, which is all that anybody cares about. And I just wanted to show you that there are several ways that U.S. debt is held, or several entities, market participants who hold U.S. debt, and they hold U.S. debt for various reasons. It serves as a safe storage of wealth for a lot of participants, including pensions. So there are independent reasons for issuing debt beyond like, hey, we need to borrow to finance spending because we need to prevent dissaving on our balance sheets, which actually doesn't make sense for a government. So speaking of the central bank, doesn't it and not government spending actually create reserves? And if you really think about it, it's not that the central bank creates reserves, and we'll see how government spending actually does this. Government spends money purchasing goods and services from the private sector, right? That would be the beginning. Even in the hiring of central bank employees, the government would have to actually spend on hiring these employees before anything. So there is government, and there's the government's origin, and the government has to spend money. It has to spend its IOUs to purchase goods and services from the private sector. In doing this, the government usually has an account with the central bank so that it can effectively write a check as a payment. But this example can work even if the government does pay in cash. But that account is how we kind of like understand this a little bit more cleanly. The central bank, when the government purchases a good or service from someone in the private sector, the central bank will transfer cash from the government's account into the reserves of the banks serving the private sector contractors. Those banks will now have an expanded loan capacity. They'll have excess reserves because they are having reserves now transferred from the government's account. And now they'll have more loan demand because the government purchases will stimulate the private sector. As the government purchases goods and services from one person, right? They purchase labor from Dora. Dora takes the IOUs. She purchases other things in the economy. She purchases food and clothing for herself in the short term. But in the long run, perhaps Dora ends up purchasing a house or borrowing for a house. And through that process, we can see that the government's purchases of the goods and services actually stimulated the private sector and led to more demand. And that leads to money multiplication. So the banks now have expanded loan capacity, and they're able to multiply money through the whole process of what's happening with economic activity. And finally, the reserves of a currency could not actually exist if the currency itself didn't exist. So the government has to actually purchase before there can even be a concept of reserves for the central bank to manage. This is a more visual breakdown of what's happening. Government spending leads to currency going both into central bank reserves, but also into the non-financial private sector in our little visual example. The central bank reserves expand access to reserves for the banks, which allow them to create more loans. There's also more demand for loans now because there's more cash flowing in the non-financial private sector. And between the two, there's now this multiplication of money going between the banks creating loans, and in those loans actually giving more cash, pushing more cash out into the economy. So, what is the purpose then of the central bank in this whole breakdown? And the point is that the government operates as a consolidated entity. And although this may be a contested idea because we really like to believe into this, we really believe in this concept of independent central banks. Um, the retort would be that any central bank that ignores fiscal decisions will basically be ineffective. And even the U.S. Federal Reserve, since at least the 40s, has been mindful of fiscal policy and determining an appropriate monetary policy. The central bank just can't actually ignore what the fiscal authorities are doing, even if they can, even if they try not to act in chorus with those fiscal authorities. Also, as a regulator of the banks, the central bank reinforces the validity of the issued currency by requiring that reserves are held in that issued currency as well. So there's another layer of monopolization added onto all of this to ensure the actual well functioning of the money economy. It also ensures that the government fulfills its responsibility to address inequality and discrimination in banking activities. So, in many ways, the central bank does act as a coordinated extension of the rest of the government. This is kind of the argument for the consolidated government that MMT theorists believe in. And then, as a lender of last resort, the central bank ensures that there will always be enough reserves to support economic activity. There is no way for there not to be enough cash available to make loans because the central bank guarantees that it will always make a loan to any bank that is a member. And in that sense, guarantees that it will always provide liquidity. If it hopes to maintain stable prices, the central bank must also stand ready to be the lender of last resort to the government in terms of buying any surpluses of issued debt. So that's another thing. Even if nobody else theoretically, again, would purchase U.S. debt, the central bank has basically taken on a position that would force it to have to purchase that debt and to maintain its mandate of maintaining stable prices. To that end, there's always going to be demand for U.S. debt, which is part of probably why the interest rate on U.S. debt is so stable despite changes in federal debt. So what are the policy implications of this? What does any of this actually mean for policy on the ground? First, let's see. There are a few buckets, and I'm going to kind of talk about large buckets of these policy implications. So the first policy implication is that sovereign governments don't need to actually run balanced budgets. A federal jobs guarantee would arguably be the most effective and efficient fiscal policy tool for achieving a full employment economy. Government purchases can't have a crowding out effect beyond the scarcity of real resources that the government is trying to employ. And members of a money union, like the European Union, can't actually run large fiscal deficits. So first policy implication, sovereign governments don't need to run balanced budgets. Because of the nature of money creation, a sovereign government, again, that prints its own currency, accepts taxes only in its own currency, and only holds debt denominated in its own currency, can never default on that debt, making it possible to borrow basically forever. And this is on the back of the government can always print more and print enough to pay its future debt and tax away enough so that in the future inflation is not an issue. And because of the relationship between the national accounts, government deficit spending allows the private sector to run surpluses that can be used to accumulate debt. So the government, theoretically, based on our breakdown of the relationships between government, personal consumption, private investment, net exports, our understanding of all that leads to the realization that for the private sector to actually accumulate savings, there needs to be a public sector surplus. And it kind of makes sense that if the private sector is going to collect dollars to actually put into saving into anything, then the government actually has to issue more dollars than it is taxing out of the system. So only if the government is running or has run a deficit can the private sector actually run savings creating surpluses. So only if the government actually does run a deficit can the private sector accumulate wealth. And we can kind of see this in the sectoral balances, where in the U.S., the private sector typically runs surpluses, which generate revenue, while the public sector typically does run a deficit, which allows the private sector to generate that wealth. Next policy implication, a federal jobs guarantee for full employment. Because of the nature of money creation, again, it would make sense that government can also purchase anything denominated in its currency without consequence from its cost. So as long as somebody is willing to be employed and accept US dollars as compensation for their employment, there would theoretically be little to no consequence to the government actually hiring them. A federal jobs guarantee would be an automatic stabilizer that would make the government an employer of last resort, effectively using government purchasing power to eliminate unemployment. The automatic stabilizer part is important because it would then be detached from the political cycle of what typically happens when a crisis occurs, and would just automatically kick in that as people basically fall off of private sector employment, they would be automatically qualified for federal employment. In some ways, this is kind of a sibling policy to the universal basic income, which would actually be a transfer payment and therefore doesn't necessarily have the same fiscal implications, because in it being a transfer payment, it is not a requirement of economic activity and therefore could actually create some level of inflation. So to some extent, there is an inflation risk with UBI that does not exist with a federal jobs guarantee. This was also not the first time that anything along this lines was suggested. It's actually a bipartisan idea. A UBI was suggested by President Richard Nixon, who was a Republican in 1970, and actually passed the House, but not the Senate at the time. And if you look at survey data today, like most recent survey data, and even data from surveys before this year, kind of show that this idea of a federal jobs program, it has popular support across the political spectrum. Policy implication, crowding out is a myth. Since the government purchases ad reserves to the banking system, theoretically spending from the government should reduce the cost for banks borrowing reserves from each other, because government spending actually creates reserves. If the government can only crowd out real resources, then that would theoretically only occur when the economy has reached full employment. And if the economy has reached full employment, then yes, government's role in that area of securing full employment is now fulfilled, and government would theoretically then not need to spend more than what it is spending to meet this full employment. But that crowding out then can't just occur from the government just spending money. It would have to occur under very specific circumstances of reaching full employment. Empirical evidence also supports this. There is a disconnect between changes in the money supply and the money base in the U.S., which suggests that banks seek out reserves after making loans, and therefore they don't actually really depend upon this concept of a scarce pool of loanable funds, that if we borrow too much of it in the public sector, then the private sector is going to suffer. Also, changes in the size of the federal debt are inversely predictive of changes in the rate of federal funds. The federal funds rate is the cost of banks borrowing reserves from each other, which suggests that at least debt financed by government spending creates reserves. So the fact that government spending utilizes real resources suggests that it may crowd in private activity by actually creating demand. When the government spends, it creates demand, not just on the first order of what it's spending on, but also on multiple orders of now allowing people who are getting those IOUs from the government to spend on other things. And when we run a regression, we do see that there is a negative predictive power of the level of outstanding debt to the federal funds rate. So as the federal debt level actually increases, indicating that government is spending and not financing its spending, we see that the federal funds rate actually does decrease, suggesting that the government spending is creating reserves that are reducing the cost of all the federal reserves. The final implication here is that monetary unions like the EU limit their members' fiscal options, and it limits its fiscal options because if you're part of a money union, then you're not a sovereign government. As a member of the money union, you can't actually print the union's currency, and you must accept tax payments in the union's currency, meaning that it's possible for the government to default on any debt that it issues if the cost of the debt, the interest rate on the debt, is not exceeded by tax revenue growth. So if government spends, if you're one of the smaller governments in the EU, let's say you're Greece, you spend on goods and services, but that spending is only met by people in your local economy taking your government spending and basically going to other countries and using it to generate economic activity there and pay taxes there, then yes, your local government will suffer because you will not see the tax revenue growth from this. And that is because you're part of a union that allows the currency that you are spending to be used in other places. So the fiscal spending can result in that capital flight, as currency of one government spends one government spends is used to pay taxes to another government. On top of that, mandatory fiscal deficit limits can compound the economic problems if the deficit limit isn't actually large enough to sustain a full employment economy. For the EU, deficit limits of 3% and debt limits of 50% of GDP may be inadequate. These unions can only theoretically work also if all members are committed to supporting any individual member fiscally. In the US, the federal government has sovereignty and is therefore the only entity able to prevent state and local governments from defaulting, and therefore has a similar relationship where the state and local governments, this federal system, is basically similar to a monetary union, which can only really work if all members in the union are committed to saving any individual member from entering a fiscal default, because then they operate in chorus. If they're not operating in chorus, then you can have capital flight that allows one member to suffer while the other members basically look on and laugh. What you see here is that the US federal government has run an average fiscal balance of negative 2.28% of GDP since 1949, which would seem like it's within the 3% range, but then you have to understand that the average since 1975 has been negative 3.2% and peaked as much as almost 10% in 2009. So we run large deficits when crises happen. And if you're a country that cannot run a large deficit when a crisis happens, it is very limiting to what you can do to avoid the crisis becoming a catastrophe. So what are some of the modern lessons to kind of wrap this up and get us to a point of like, how does MMT apply to us today? In correcting national atrocities, Derek Hamilton, a stratification economist, recently endorsed a contract with Black America, which basically advocated for an MMT approach to help finance a 18 to $20 trillion over 10-year program to deliver reparations to descendants of American slavery and to Native Americans. So in that sense, MMT kind of opens the door to the ability to correct for these issues. Bailing out households, negotiations for a second round of substantial fiscal stimulus stalled in late 2020, summer 2020, and it may have unnecessarily caused hundreds of thousands of people to fall into unemployment weekly, when honestly spending on this and in general spending on full employment is probably exactly what a government should do, especially under MMT considerations. Strengthening healthcare during a pandemic, Senator Sanders' Medicare for All proposal was often criticized for the deficit spending it was expected to require, although those critiques may hold less weight than thought if we really believe in the MMT logic, and especially during a pandemic where everybody seems to need healthcare. Finally, supporting state and local governments like Greece and the European Union. State and local governments here and their constituents are guaranteed to endure cycles of fiscal emergencies if the federal government refuses to be a reliable source of aid. It is the only government within the United States that is sovereign. The federal government is the only one that can borrow and spend and print in its own currency. And therefore, it is the only one that can actually help localities achieve full employment. So finally, honestly, the whole point of this is to really reconsider the political narrative happening around us. Whether we're talking about people like Senator Feinstein, who was captured lecturing children on why the federal government couldn't help them deal with climate change, just didn't have the money to spend on dealing with climate change that is a existential threat to their future. Or whether we're talking about, on the Republican side, Senator Rob Portman, who has shown more enthusiasm for giving corporations tax breaks through the Tax Cuts and Jobs Act of 2017 than for any infrastructure investment idea in the most recent past. these both of these sides reflect the same coin, that the government runs a budget that requires balancing, which is really more akin to lessons that we learn from households about saving and dissaving. They don't apply to a government that just needs to ensure that its constitution mandates are met. And ensuring that those constitution mandates are met can be done without ever fully financing government spending that occurs. As long as that government spending is done in a way that it ensures full employment, helps grow the economy, and as long as that government is sovereign, we should really have no issues whatsoever to deal with. The US government is in a perfect place to exercise this, and therefore we should really reconsider how these conversations are going today if they're actually informed by modern understanding of monetary theory or even a modern understanding of macroeconomic theory in general. Hopefully this was a clear introduction. Again, it is just an intro to MMT. There's a lot more in MMT that we could go into that would require its own whole video, but hopefully this gives you a rough idea of how MMT gets its origin story down, how MMT in its most fundamental way justifies its theories, and what type of empirical evidence, what type of real world evidence supports the concepts laid out in MMT.